The Federal Reserve's interest rate decisions have far-reaching effects on nearly every aspect of personal finance. From car loans to credit cards, mortgages, savings accounts, and student loans, the central bank's policies play a crucial role in shaping how much consumers pay to borrow and how much they earn from their savings. After a series of rate cuts that lowered interest rates by a full percentage point last year, the Fed is expected to hold rates steady. While this means that borrowers may have to wait longer for cheaper loans, savers can enjoy relatively stable yields. However, economic uncertainty, driven by President Trump's policies on tariffs, immigration, and federal job cuts, has led the Fed to take a cautious stance. With its benchmark rate set between 4.25% and 4.5%, the Fed is balancing inflation concerns with economic stability. But what does this mean for your finances? Let's break it down into 5 key areas. Auto loan rates have been climbing, and car prices remain high, making affordability a challenge. On top of that, U.S. tariffs on imports could push prices even higher. Car loan rates typically follow the yield on the 5-year Treasury note, which is influenced by the Fed's policies. However, other factors such as credit history, vehicle type, loan term, and down payment affect how much you actually pay. Lenders also consider default rates. If more borrowers fall behind on payments, interest rates tend to rise. Current auto loan rates. The average new car loan rate was 7.2% in February, up from 6.6% in December. Used car loans averaged 11.3% in February, rising from 10.8% in December. How to get the best rate? Get pre-approved through a credit union or bank before heading to a dealership. When negotiating, focus on the total car price rather than just the monthly payment, which can mask costly loan terms. Credit card rates had slightly declined after the Fed's recent rate cuts, but the decreases have been minimal. Last week, the average credit card interest rate was 20.09%. Since most credit cards have variable rates, they tend to move in response to changes in the Fed's benchmark rate. However, your credit score and the type of card you use also affect your rate. Rewards cards, for example, typically carry higher interest rates. Where to find better rates? The Consumer Financial Protection Bureau reports that large credit card issuers charge rates 8 to 10 percentage points higher than smaller banks and credit unions. Switching to a smaller institution could save you $400 to $500 in interest per year. Negotiation. Tip: call your current card issuer and ask them to match a lower rate you found elsewhere. If transferring your balance to a new card, be mindful of fees and post-introductory interest rate increases. Mortgage rates have been on a roller coaster ride. Rates peaked at 7.8% late last year, fell to 6.08% in September, and then ticked up slightly due to economic concerns surrounding inflation. While 30-year fixed mortgage rates don't directly follow the Fed's benchmark, they do track the 10-year Treasury bond yield. Expectations about inflation, Fed policy, and investor behavior all play a role in determining mortgage rates. Current mortgage rates. The average rate for a 30-year fixed mortgage was 6.65% as of last week, up slightly from 6.63% the previous week, but down from 6.74% a year ago. Where to find the best rates? Always get multiple mortgage rate quotes on the same day from brokers, banks, and credit unions. Compare not just the interest rate, but also discount points and lender fees to get a true apples-to-apples comparison. For those with home equity lines of credit or adjustable rate mortgages, which move more closely with the Fed's decisions, expect rate adjustments within 2 billing cycles of any Fed action. Savings account and CD rates have been climbing alongside the Fed's rate hikes, offering better returns to savers. While rates may not rise further in the near future, they are still relatively high compared to historical averages. Where to find the best rates? Online banks continue to offer competitive savings, account rates above 4%, while traditional banks lag behind with a national average of just 0.6%. Investment consideration. Money market funds are another attractive option, with yields around 4.14% as of last week. ShopSmart. Websites like depositaccounts.com track rates across thousands of institutions and can help you find the best offers. For student borrowers, there are two main types of loans: federal and private. Federal student loan rates are fixed and reset each July based on the 10-year Treasury bond auction in May. Current federal loan rates: undergraduate loans, 6.53%. Unsubsidized graduate loans, 8.08%. Plus loans for parents and grad students, 9.08%. Private student loan rates vary widely and depend on factors like credit score and co-signer requirements. If you're shopping for private loans, be prepared to provide detailed personal information before receiving a quote. Best strategies. Federal loans should be your first option due to their fixed rates and generous repayment terms. For private loans, shop around extensively and compare fixed versus variable rate options carefully. The Fed's rate policies shape the financial landscape, influencing borrowing costs and savings returns. While rates are expected to remain steady for now, economic uncertainty could shift the outlook. Borrowers. Be strategic when taking on new debt. Shop around, negotiate where possible, and keep an eye on market trends. Savers. Take advantage of high-yield savings accounts and CDs while rates remain favorable. Homebuyers and homeowners. Lock in mortgage rates when they are attractive and explore refinancing options if rates drop. Students and credit card users. Look for better interest rate options, negotiate with lenders, and stay on top of your financial commitments. The key takeaway? Stay informed and proactive. By understanding how Fed policies impact your finances, you can make smarter financial decisions and navigate economic shifts with confidence.